Subscribe to my channel Report Stock.
Welcome to the deep dive. Today, we're plunging into the recent Q4 earnings report for Palo Alto Networks, PANW, as most people know it.
Right.
You shared some key bits and pieces, analyst estimates, and our mission, really, for this deep dive is to pull out the important stuff, help you understand what these numbers actually mean.
Because those PANW numbers looked strong, but then you look at the stock.
Exactly. It's easy to just see the headlines, right? But the real story, the insights, they're often buried in the details, especially when investors are, really picking apart every single number. Cybersecurity giant.
Okay, let's unpack this. First up, the big ones, the numbers everyone sees first. Revenue and earnings per share. EPS.
Headlines.
Yeah. So for the quarter ending July 2025, Palo Alto Networks reported revenue of $2.54 billion.
Okay.
Now, to give that some context, that's up, let's see, 15.8% over the same time last year. Pretty robust.
Decent growth, yeah. And here's an interesting point. That number, well, it represents a surprise of plus 1.46% over the Zacks consensus estimate. That was $2.5 billion.
Right. And that Zacks estimate, for you listening, it's basically Wall Street's average guess, pulling together lots of analyst forecasts.
Exactly. So beating it even, by 1.5% or so, it signals they did better than the market expected on the top line.
Right. And these expectations, they're just so crucial, aren't they? They really drive how the market reacts.
Totally.
Now, on the earnings side, EPS. That came in at $1.95,
Okay.
which is a solid jump compared to $1.75 in the year-ago quarter.
Yeah, okay.
But when you compare that to the consensus estimate, which was $0.88.
Ah, so an even bigger beat there.
Yeah, a much bigger surprise here, plus 7.95%.
Wow.
So yeah, these initial numbers, they definitely look strong on the surface. A powerful opening statement for the quarter, you could say. Clearly beating Wall Street.
But as we always say, the headlines, they often miss the deeper story. Our research really nudges us to look past just revenue and EPS. It asks, what were the analysts really watching closely?
Exactly, because that's where the real clues about a company's health can emerge. The nuance.
So what key operational metrics did you see highlighted?
Where these deeper metrics, they often give investors maybe a more accurate projection of where the stock might go. They influence those top and bottom lines eventually.
Makes sense.
So let's start with RPO, remaining performance obligation.
Okay, RPO, always a big one for subscription businesses.
Huge. It came in at $15.8 billion. Now, the average estimate from 6 analysts was $15.26 billion. So a beat there, too.
$15.8 billion. That's a lot of future revenue locked in.
It really is. And for a company like Palo Alto Networks, RPO is, well, it's more than just future revenue. It signals customer loyalty, the strength of their platform long term.
Right. It's like contracted business.
Exactly. Think of it like a builder with a solid backlog of confirmed projects. It gives you visibility into future income. And that's gold for investors, especially in recurring revenue models like cybersecurity.
Good analogy. Okay, what else?
So if we break down the revenue by segment, that tells us more too.
Right.
Product revenue. This hit $573.9 million.
Okay.
That was better than the 14 analyst average estimate of $553.4 million. And it showed a pretty significant year-over-year change, plus 19.4%.
So strong growth in their actual product sales, hardware, software.
Seems like it, yeah. Then the bigger piece, subscription and support revenue. That reported $1.96 billion.
And how did that compare?
Just slightly above the $1.95 billion average estimate from 14 analysts. So pretty much in line, maybe a tiny beat. And that was up 14.8% year over year.
Okay, so that larger recurring chunk was basically on target.
Pretty much, yeah.
Now, within that big subscription and support number, I remember our source material even drilled down further into support and subscription separately.
That's right. Good catch.
What did those specific figures tell us about the health of those core recurring services?
Yeah, great question. So diving into those, support revenue was $647.4 million.
Okay.
That was actually better than the 3 analyst average estimate of $625.85 million. And it showed an 11.3% year-over-year change.
So support beat expectations. That sounds positive for, customer retention.
Yeah, definitely a positive indicator for customer satisfaction, keeping existing customers happy. Then the subscription revenue piece was $1.32 billion.
And that one?
Exactly matched the $1.32 billion estimated by 3 analysts. bang on the number.
Okay.
And that represented a strong plus 16.6% change compared to the year-ago quarter.
So stable, predictable performance there. Met expectations exactly.
Yeah, suggests things are ticking along as expected in their core subscription offerings.
So it really seems like they largely hit or beat the estimates across these really key operational revenue categories, especially, like you said, in product sales and the support side of services.
Yeah, the picture painted by the revenue breakdown is largely one of executing pretty well on their promises.
Okay. But revenue's only half the story, right?
Yeah.
We need to talk profitability.
Absolutely. Gross profit.
Yeah, the source material gave us a look at that too. Tells us how efficient they are at actually delivering those products and services. Looking at those gross profit figures, I noticed maybe a slight miss in the non-GAAP subscription and support profit. What might be going on there, operationally, I mean? Are they investing more? Costs shifting?
Yeah, that's a crucial question. How efficiently are they turning that revenue into gross profit? And we see both non-GAAP and GAAP figures here.
Right. Always important to distinguish those.
It really is. You know, GAAP, generally accepted accounting principles that gives you the standardized view, helps compare across companies. But non-GAAP, well, companies use that to show or try to show underlying operational profitability. They often exclude things like stock-based compensation, maybe some M&A costs.
Right, trying to show the core business performance.
Exactly. So let's look at Palo Alto's conversion through both lenses. Product gross profit non-GAAP, $440.9 million. The estimate was $435.03 million.
So a beat there.
Okay, good on product and non-GAAP.
Then subscription and support gross profit non-GAAP. This came in at $1.48 billion. The estimate was slightly higher, $1.5 billion. So a slight miss there on the non-GAAP service margin.
Okay. And the GAAP figures?
Product gross profit GAAP, $437.7 million, which actually beat the $422.66 million estimate quite nicely.
Interesting.
But then subscription and support gross profit GAAP, $1.42 billion, just a hair shy of the $1.43 billion estimate.
So similar pattern on the GAAP side for services, just slightly below expectations.
Exactly. So while things are generally strong and their product margins look, pretty healthy, it is interesting that both non-GAAP and GAAP subscription and support gross profits just slightly missed.
Yeah.
And to your point, it might indeed signal maybe slightly higher costs than analysts expected in those key service areas. Could be scaling up support, cloud infrastructure costs, something like that. Right. Not a huge red flag maybe, but something to keep an eye on.
Precisely. It's a data point to watch, even if the overall picture still looks pretty positive.
Okay. So we've unpacked the numbers. Generally strong report, right? Beats on revenue. EPS mostly hitting or exceeding on the key operational metrics.
Mostly, yeah. With that slight caveat on the service margins.
Right. But then the market reaction, the stock price, it doesn't seem like it's just cheering these results on.
No, it doesn't.
Our source material had that fascinating detail about the stock's recent performance. It almost feels like the stock is telling a completely different story from this earnings report.
What? Yeah.
What could possibly be causing that disconnect?
That really is the million-dollar question, isn't it? Because, earnings tell us about the past quarter.
Right.
History. But the stock market, it's always trying to price in the future. Our source states that shares of Palo Alto, PANW, have returned minus 9.6% over the past month.
Minus 9.6%.
Yeah. It really highlights that reported earnings are just one piece of the puzzle for investors.
Especially when you compare that. The S&P 500, the ZAX composite, was up 3.5% over the same period.
Huge contrast.
So, strong earnings report here, but the stock is down significantly relative to the market. Is there anything in these numbers we just talked about that might explain that? Or are we looking at, external factors, guidance, something else entirely?
That's the crucial distinction, yeah. Because while these Q4 numbers were strong, the stock performance suggests that despite those positive surprises, other factors are likely weighing on investor sentiment. We aren't seeing an obvious smoking gun right here in these Q4 results necessarily. It could be maybe cautious forward guidance they gave for the next quarter, or just broader macroeconomic worries hitting the tech sector, maybe competitive pressures that analysts are now baking into their future models more heavily.
Right, future expectations.
Exactly. And the source also notes the stock currently holds a ZAX rank #4. That's a sell.
Okay. And what does that ZAX rank tell us, really?
Well, for anyone not familiar, the ZAX rank is this proprietary system. It heavily uses earnings estimate revisions to predict stock performance. So #4 sell rank suggests that, on balance, analysts are actually lowering their future earnings expectations for PANW.
So even though Q4 was good Analysts are maybe becoming less optimistic about the next few quarters.
That's what the rank implies, yeah. Historically, that points towards potential underperformance compared to the market in the near term. It just shows that complex dance between reported results, future expectations, market trends, all playing together.
What an illuminating deep dive this has been.
It really connects a lot of dots.
Yeah, we've thoroughly unpacked Palo Alto Network's Q4. We saw the strong beats on headline revenue and EPS. We saw mostly positive performance on key metrics like RPO, product revenue, the core subscription streams.
Right. And we also pinpointed where those gross profit figures for services just slightly missed the mark, maybe hinting at some cost factors to consider.
And then we tied all those reported results to that really intriguing fact about the stock's recent performance, how it hasn't really mirrored the positive earnings news at all.
Yeah, showing a decline, even against the broader market. It really underscores that analysts and investors, well, they're always looking ahead, aren't they? Beyond just the last quarter's results.
This deep dive, it just perfectly highlights that understanding a company's financial health, it goes so much deeper than just glancing at the headlines.
Absolutely.
It's about digging into those subsegments, understanding the nuance of analyst estimates, knowing the difference between GAAP and non-GAAP, and critically, how the market is actually reacting to, well, a whole mix of factors.
Couldn't agree more.
So, for you, our listener, here's maybe a thought to chew on. When you next look at an earnings report, any company, what are maybe 3 specific metrics, beyond just revenue and EPS you would now really look for to truly grasp the company's performance and maybe its future prospects? And what questions would you ask about those numbers?
That's a great takeaway. Thinking critically beyond the headlines.
Subscribe to my channel Report Stock.